Ever wondered what a leveraged ETF is? Well, before we dive into that, let's start by understanding ETFs, or exchange-traded funds. Imagine a basket, but instead of fruit, it's filled with different types of securities like stocks, bonds, or commodities. This basket is what we call an ETF. Now, this isn't just any ordinary basket. ETFs are special because they're traded on an exchange, just like individual stocks. You can buy or sell shares of an ETF during trading hours, just like you would with any other stock. But the real beauty of ETFs lies in their ability to track a specific index or sector. If you've ever wanted to invest in the entire tech sector or the top 500 companies in the US, there's probably an ETF for that. But what if you could magnify the returns of an ETF? That brings us to leveraged ETFs. Now, imagine an ETF on steroids. That's what we call a leveraged ETF. This potent financial instrument uses financial derivatives and debt to amplify the returns of an underlying index or sector. Think of it as a magnifying glass that can amplify both the gains and losses. So how does it work? Well, a leveraged ETF strives to deliver multiples of the performance of the index or sector it's tracking. For instance, a 2x leveraged ETF aims to deliver twice the daily performance of its benchmark. But remember, with great power comes great responsibility. The same leverage that can lead to significant gains can also result in substantial losses. It's like a double-edged sword. That's why it's essential to understand the potential risks and rewards associated with leveraged ETFs. Before we move on, if you're finding this content helpful, don't forget to hit the like button. So, we've covered what a leveraged ETF is and how it works. Now, let's summarize. Leveraged ETFs, in essence, are financial instruments that use borrowed money to potentially amplify the returns of an underlying index. They're like regular ETFs, but on steroids, aiming for double or even triple the daily performance of a specific index. However, this comes with a catch. The potential for higher returns is met with the potential for larger losses. If the index goes down, your losses are amplified as well. These ETFs are typically used by seasoned traders who are comfortable with higher risk. If you're a conservative investor or new to the game, leveraged ETFs might not be your cup of tea. They demand constant monitoring and are more suited for short-term trading than long-term investing. Remember, with leveraged ETFs, high reward comes with high risk. So make sure you understand what you're getting into before you invest.